started here in just a minute. Great, guys. Thanks for doing that. If you'll excuse me for just a moment, I'll get that recording fired up, and we'll come back to a formal introduction for recording purposes, and then we'll launch right into the content for today. Hello, everybody, and welcome. I'm Toby Gennaro, and I'll be your presenter for today. The topic for today is a modern approach to technical trading, and I'll be talking through really just the fundamental components of the trading strategies that you'll be learning in parts 2, 3, and 4 of this 4-part series. So the fundamentals today will consist of really just an overview of the technical analysis tools that are going to make up the trade strategies that you'll be learning later. So for those of you that are on the live webinar today, if you have any questions during the session, you can type those into the question box on your screen. I'll be asking you some questions as well. We'll try to keep this interactive. If you happen to be watching this via recording in the future and you have some questions, you will be able to send those in as well, and I'll have some contact information for you at the end of the session so you can do that. And I just need to put up this risk warning and disclaimer. I need to leave this up for about 30 seconds or so. If you all could have a quick read through this, that would be great. What this is saying in brief is that we provide education only, which means we do not give any financial advice. And as most of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. And if you can't accept these terms, we ask you would please cease watching the presentation and consult our website for more information. Okay, everybody good? And then just one more disclaimer here from Trade with Precision. If you can have a quick read through this one, a little longer one. Okay, everybody had a chance to glance through that? All right, so this webinar is brought to you by two organizations, so I just want to take a minute here to introduce both companies so y'all understand. Oanda was co-founded by two gentlemen, Dr. Michael Stoom and Dr. Richard Olson, and by the mid-1990s, Oanda quickly became one of the first companies to offer currency exchange rate information online for free. And so this was, as you can imagine, very appealing to Fortune 500 corporations, you know, having their operations located around the globe, and really having a need to better understand their foreign currency risk exposure at any given time. So Oanda then incorporated in 1996 and was again one of the first companies to offer fully automated online currency trading. So the company's web-based platform known as FX Trade was launched back in 2001, and it provides both retail as well as institutional clients a state-of-the-art trading platform. So current trading volumes are in excess of 1 million transactions a day. And last year, Oanda was named the best trade execution provider and the best retail trading platform, among a number of other awards. So just a brief history there of where Oanda has been as an organization and some of their key milestones. Trade with Precision was created back in 2006 by a gentleman by the name of Nick McDonald as a provider of trading education for retail traders. So we are an international team of traders that provide training for some major brands of exchanges and brokers around the globe. And we teamed up with Oanda just about 2 years ago to bring you folks some specialized education around currency products and trading strategies. So Trade with Precision is a company run by traders for traders, and we are specialists in trading strategy education. Now the agenda for today, we'll go ahead and introduce the Forward Thinking Traders series. Okay, initially today we'll take a quick peek at those trade strategies and what they look like. We'll talk about concepts like thinking in probabilities and really how to think like a trader. And we'll go ahead and introduce the concept of price action mastery and how you want to, what you want to look for in an optimal price structure for trading. Okay, so we'll talk about how to identify price trends and then how to determine the probability for a continuation of that trend. We'll look at a number of chart examples throughout this session today to begin building a checklist of the items that we need to form this high probability trade setup. Okay? So let's go ahead, jump in right here, and we'll give you a quick overview of what we'll be doing in the session today. Now, if any of you folks have any questions throughout the session, we're going to be going for about 2 hours here. Just fire over a question using the question box on your screen. Want this to be interactive. If I haven't misstated something or you don't understand something, just let me know. I'll be checking the questions on my end pretty much after every slide. And if I can respond to something while it's still fresh in your mind, be more than happy to do that. Okay. All right, so the Forward Thinking Trader series is an advanced strategy course where you'll learn to trade two trading strategies. Okay, this is a new series that we've developed specifically for Orlando clients to just help take your trading to the next level. Okay, so this series will provide you a deeper perspective on modern technical analysis and trading strategies and why that's important to you as a trader. So we'll help you understand our modern perspective relative to analyzing price action on the charts and then coming to a decision on a trade idea. So the two trade strategies that we'll teach in this series are both strong trend following strategies, and they're rooted in technical analysis of the underlying price action. So let's go ahead and take a look at the two strategies just to give you guys an idea of what you can expect. Now this right here is a chart structure that we'll be looking for to identify the entry for the trend flow trade strategy. Okay, this strategy will include a checklist that you'll be able to use systematically on each and every trade. And in this strategy, we'll be looking to buy or sell these pullbacks within a well-defined trend. All right, so you'll learn about buy and sell zones and how to use the moving averages to identify the correct chart structure for this particular trade setup. Now the content that you'll be learning today, it'll just help you to list out all of the reasons for taking this short trade, including your entry, your stop, and your targets. So price action mastery will be really one of the key concepts to learn here. So your eyes will be trained to recognize an optimal chart structure for trading, which is going to help you. And we're looking for, smooth flowing price action, just like what you see here, consistent candle formations, specific patterns in the moving averages, a specific pattern in the price action itself, and also things like, indicator convergence are going to be important to us as well, to help us identify whether this trend is likely to continue in the current direction or whether maybe it's about ready to reverse. Make sense? Then another look at a trend flow strategy going long right here. We have an optimal chart structure again, predictable price action to the upside, successive higher highs and higher lows to form this price action structure. Multiple time frames, then confirming the same trend direction, and the indicators look very bullish as well. And we have a decent reward to risk ratio on the trade, which is important since we always want to know how much we're prepared to risk in order to obtain the anticipated payout that we're looking for. So many amateur traders make just a very basic mistake by not considering their downside risk on a trade and only looking at the profit component of that trade. Okay, so we'll show you how to do both in this series and how to make sure that you balance out risk with reward. Munir's got a question. How do we utilize the RSI and the MACD and the price action? We'll actually show you that, Munir. We do things a little bit differently than the buy and sell signals that these indicators, the RSI and the MACD, provide you. We're not trading the line crosses of the MACD, and we're not trading the overbought and oversold signals on the RSI. So we're using these indicators in a slightly different way to make them leading indicators that will predict where price action is going to go. So we'll be showing you that in some of the other sessions. We'll be using that a lot, going through a lot of trade examples to help you understand that. Okay. Now this is the chart structure that we'll be looking for to identify the entry for the momentum breakout strategy. Now this strategy will include a checklist as well that you'll be able to walk through systematically on each and every trade setup. So in this particular trade scenario, we'll be looking for these flat levels right here that you can see I have highlighted here, but it's basically just a flat line. And so in this particular trade scenario, we'll be looking, for price to be basically putting in kind of a perfect level of several touches, 2 or more touches here that are very precise, that form this flat level that will define our entry for this momentum breakout strategy going short in the direction of the trend. Okay, so the content that we'll be learning in this series will just help you to list out all the reasons for taking this short trade, the entry, the stop, and then how to estimate your profit targets based on this flat level setup. And then another look at a breakout strategy in action right here across multiple time frames. Okay, all charts confirming the setup, all charts confirming the upward trend and also confirmation of a pullback structure. So multiple touches defining our flat horizontal level right here, going long and looking for the breakout in the direction of the predominant trend, which is higher. So the indicators are converging as well. As we can see on the MACD and the RSI, the price action is making higher highs and higher lows as it trends up into this flat level on the, on some of the lower time frames as well as the higher time frames. And so a very good trade setup here with good probabilities for a successful outcome. So you'll also notice here as well on the higher time frames that we have the trend flow setup as well. We have price pulling back into that buy zone. Bullish candles are setting up. But on the lower time frame, we have a flat level looking to break up in the direction of the higher time frame trend flow trade. So a little bit of a combination of both trending strategies working across multiple time frames. So let's start off here just by understanding a basic concept like thinking in probabilities. In order to be a better trader, you really have to begin to think like a trader, right? So here are a few concepts that we've learned from being in this business for a while. And with regard to learning a new trading strategy, swing trading will typically allow just a lot more time to analyze the strategy setup and then have you be able to plan out your trade versus the more faster-paced day trading routine. So with day trading, since you're working on the typically the lower time frames, your decision time on each trade needs to be quick and decisive, and this can sometimes be a challenge when you're first learning to trade with these strategies. So your mindset as you approach the markets is going to be a very critical factor in determining your success. Most amateur traders do not place enough emphasis on this concept, and instead what they do is they look for more tangible items that drive them toward making money instead of their trade execution skills in the markets. So we all have bad days in trading the market, but it's really how you bounce back from a bad patch that can really set you up just as a better trader as opposed to winning from the outset or from the get-go. So the bad patch can really help a trader to respect the markets and again consider the risks of trading prior to entering a trade. So risk before profits is kind of the mindset that you want to have. And when you're considering a trade, make sure that it conforms to your defined rules and your trading strategy. And this will make your results just more consistent and predictable over the long term. The strategies are important. They're crucial to our success as traders, but you have to have a focus on risk management in order to survive the markets long term. The Atlanta Trade Leaders program is a form of mentoring by making it possible to follow the trades of a select group of experienced currency traders. The benefit here is very obvious. Everyone learns better and faster by having a mentor, but you also get to maintain control of your account while you're in the process. So the biggest amateur mistake is focusing on making money in the markets and usually making it too fast. Okay, amateur traders are usually risking an unknown amount of money in order to achieve their profit objectives, and that's just really just a setup for failure over the long term. Always want to know your risk prior to entering a trade, and this also provides you a way to determine the success of that trade. Okay, so in other words, I risked $1 to make $2, and if you don't know your risk parameters, then you really have no way of validating a profitable trade and what you actually did. So this just helps us as traders to be wrong on a certain percentage of trades, a certain percentage of the time, and to then not blow up our entire account in the process. Now, many traders enjoy a very unique lifestyle in this line of work, but there is a common misconception about trading for a living. Many folks think that you have to be in front of your computer screens 8 hours a day, and you'll need to place numerous trades in order to accomplish this. And really nothing could be further from the truth. I mean, many times you'll find that fewer trades will yield better results, provided that you're trading a solid trend. So get in the habit of finding good trade strategy setups that have the potential for a large move, and usually you'll find these setups on the higher time frames in the form of a pullback. So this can save a lot of time just needlessly scanning the markets if you're focused on the higher time frames and looking for the big moves as they set up. However, if you are an intraday trader, then you'll need more time in front of your screens to capture the intraday swings of the market. So both traders in this business can be profitable. Really just depends upon your lifestyle commitments and the actual time that you have to trade. Okay, both trading styles, swing and intraday, just offer their own unique set of benefits. So in either case, to be a good trader and profitable in the markets, you'll need to be focused on selecting trades that conform to your strategy rules. Okay, it's not about the amount of time that you spend watching your charts or the number of trades that you make, but it's about finding high-quality trading setups that enforce the discipline that you've chosen as the basis of your trading business. Does that make sense? Another question here. I'm practicing with with 4 moving averages: the 10, 20, the 50, and the 200, and I have only 25% success. It really depends upon what you're doing. I mean, when you're first starting out with these strategies, you want to try to get to 50%. That's really your goal. Get to break even, and there's something going on with your ability to identify a strong trend. So remember that the strategies only work in strong trending markets. So you have to make sure that you've got the 4 moving averages across multiple time frames. If you're just looking at a couple of time frames and ignoring the rest, then you're going to have problems. You're not going to be trading with the higher time frame trend. So even if you're trading with a 1, a 2, and a 5-minute chart, you still want to make sure that you're trading in the direction of, say, the 60-minute chart, or trading in the direction of even, say, the daily chart. Okay, because that can really help you get some longer moves, and you'll find that you're going to get stopped out a lot less when you're trading in the direction of the higher time frame trend. Let's see. Just checking some other questions here. So I think I've got Raheel from Oanda. He's answering some questions for you guys. So one person, HB, was asking, how do we get on the Oanda Trade Leaders Program? And you have to be an Oanda client first to do that. So you have to have a live account. Demo account won't work for that. And once you have a live account, you can get a call into customer service, and they'll help you get linked up with that program. Okay. All right, so the first step in learning to think like a trader, you really need to get your head around this idea of, accepting that your mindset is among the defining characteristics that will determine your trading success. So I really can't put it more simply than that. I mean, some folks are so afraid to lose money in the market that they actually prevent their own success. Others are focused on the outcome of each individual trade, and they really can't see the bigger picture of what they're trying to accomplish over a longer time horizon or a larger sample set of trades. So there was a guy by the name of Jack Schwager. He wrote 2 very good books where he interviewed some of the best traders in the world at that particular point in time. 2 books by the titles of Market Wizards and New Market Wizards. And these books are really a must-read for everyone considering trading as either a primary or a secondary source of income. So Jack interviewed and then determined the similarities and the differences between these traders to try and make sense of this phenomenon that we call trading. And the outcome of these 2 books are some very, very interesting lessons to learn. If you haven't read this book, make sure you go ahead and get it. It's definitely worth the read. I don't have any attachment to this book whatsoever. I just I'm a firm believer. This book by Jack Schwager is an interview with many of the top traders and investors of the time. The idea behind this book was to interview these traders and then get a comparison of the kind of people that they were. Okay, so many of them came from different backgrounds. They were in different age groups when they began trading. Some of them had formal education in various degrees. Others did not. The group actively traded different markets. Some traded bonds. Others traded equities. Some did foreign currencies, and still some traded various futures commodities markets. So this group of traders also traded different time frames. Okay, some were intraday traders. Others were swing traders, and still some others were more buy and hold long-term investors. So the interesting thing about this book is that even though they all traded differently, they traded different markets, they traded different time frames, they were all incredibly successful at what they did and in the way that they did it. Okay, so many times in these sessions, folks will ask, hey, what time frames are best to trade, or what markets do you trade, or which ones are better to trade, or who's more successful? Is it intraday traders or swing traders, or longer term buy and hold fundamentalists? And so what this book does is it really kind of cuts to the quick about all that and just removes a lot of the wrong thinking that people have about the market in terms of how to make money consistently in the market. A few more differences here between these traders. Some of them were technicians, others were fundamentalists, simply meaning that some used price as their primary reason to trade, and others used various fundamental data like economic news, interest rates, etc. And so these traders all traded for different reasons. Some traded for their own account, others traded for institutions. Many of them were self-taught, others had a mentor of some kind or another. Most of the group were discretionary traders, with some being automated or algorithmic oriented, and some traded as part of a group, others just traded as individuals. So the main point being, did they all have a common trade that actually made them successful? And if so, what was the common denominator between all of these traders? And so the common factors that they all shared were really a couple of things. Okay, for one, they all had absolute confidence in their trade strategy, and this is only something that can come from experience. So as we continue to talk about trading strategy in these sessions, you can be rest assured that it's about you implementing the trade strategy properly and not the other way around. Okay, so as you develop more experience with the trade strategies, you'll come to have a finer appreciation of the discipline that you need to have when trading the markets. And so they all had a well-defined discipline and a well-defined set of rules to follow for their trading, and they were all very adept at sticking to the plan. And this only comes from having confidence in what you're doing, right? You can also say this a different way. Confidence comes from having good discipline, and confidence and discipline create a solid foundation for trading experience. Market wizards had a serious emphasis on risk management as opposed to making money in the markets. Okay, we've talked about this one before on some previous webinars in terms of thinking about your risk first on a trade rather than how much you stand to profit from the transaction itself. What do I actually stand to lose on this trade is really the proper way to approach the markets and think about your trade setup. The wizards all considered their trading success to be the cause of flawless execution of their defined rules, not necessarily whether their trades were profitable or not. So again, if we can execute the strategy flawlessly, then we'll develop confidence in the strategy over a large sample set of trades, and that will keep you disciplined throughout your trading. And then lastly, this group of traders had the tendency to think in probabilities. Okay, simply meaning that we're stacking the variables just slightly in our favor, and we know by doing that we'll profit more often than we lose, and we also profit more than we typically lose on the average trade. So if we tie all this up together, trading is about discipline, it's about controlling our emotions, it's about having patience and the correct mindset to approach the market successfully. Okay, so a great book. Take a read if you get a chance. So let's look at this concept of probabilities a little further. Okay, as traders, our job is to manage our risk of loss. Okay, not necessarily our profits. And that may sound a little bit counterintuitive to some of you, but the idea here is if we take care of our trading capital, then our profits will essentially take care of themselves. So let's explore this concept of probabilities through a little game that we'll play here. So if I have a fair coin, okay, simply meaning there's a 50-50 chance of heads or tails with that coin, and if I flip heads, then let's say that you win $15 every time I flip heads. And if I flip tails, then you lose $10. And what we'll do is we'll flip this coin once a day for an entire year. We'll give it 365 flips. So as the game is set up, okay, this represents a 1.5 to 1 reward to risk ratio with a 50-50 chance of success. So thinking in terms of probabilities, let me just ask you guys all a question. Would you choose to play this game the way it's set up right here? Okay, so it's a fair coin, 50-50 chance of heads or tails. When I flip heads, you win 15. When I flip tails, you lose 10. Just use the question box on your screen. Send me over your answer. Whether you would play this game or not, just give me a yes or no, and whether you would play it as it's set up. All right, so just taking a look across some of your responses here. Most folks are jumping in saying, sure, I'd do it in a heartbeat. Yes, of course I would. Absolutely, I would. Okay, so here are the results from a random number generator program. So out of 365 coin tosses, this program yielded 195 heads and 170 tails. So almost about 50-50. Okay, the actual ratio of heads to tails here was 53 wins, 53% wins, 47% losses. So go ahead and take a look at this chart just to see the win streaks and some of the losing streaks from this random number generator. I mean, would you have expected, something different than what you see here? And you'll notice that the longest run of losing trades was 10 coin flips. Okay, most other streaks were in the range of 3 to 5 flips. Now, do you think that you would have actually hung in there after a run of, say, 10 straight losses? Okay, you lost $100. Do you think you would have still stuck around? What do you think of the win-loss ratio of 53 wins and 47 losses? Would the probabilities have earned you a profit on this game? Well, let's go ahead and take a look at the next slide and see if we can figure out how to think in probabilities before we actually ever start playing a game. So let's talk about the results of that example and what they mean to us as traders. So in order to completely remove emotions from our trading, we need to understand a couple of things about any trade strategy. Okay, first, the win-loss ratio. So we're talking here about how many trades out of 100 will the strategy win and how many times will it lose. And when we're thinking about this concept here, we need to understand the random rule of 50-50. Okay, so if we have a game of even chance like we do here, and our reward to risk is even money, simply meaning it's 1-to-1 reward to risk. For every dollar that we risk, we stand to make $1. This scenario from the onset is basically a break-even proposition, right? If you're going to win as often as you lose and then win or lose the same amount, $1, it figures then that you'll never really be able to get beyond break-even playing this type of game. And that's before you ever flip the coin. You know that. Second, the reward to risk ratio. Okay, so for every dollar that we risk, what do we stand to profit in return? So as I just mentioned, in a 1-to-1 scenario, we're risking $1 to effectively make $1. But in order for this game to be profitable, we need to adjust one of two criteria in order to create an edge for ourselves in this game. So we either need a better reward to risk proposition, or we need to win more often than we lose, or is it possible for us to have both? Now, if you recall, to play the game, you had to accept the random result for each coin toss, right? That was part of the game. And you also had to accept that you could either make money on the game or you could potentially lose money. But you were given all of the essentials to really understand in advance of playing this game what the outcome would be. Does that make sense to everybody? So you actually knew what the outcome would be before any coin flip was made. So in other words, you had enough information prior to any coin toss to determine whether the game would actually generate a profit for you. And once you realize that fact, then it was really just a matter of allowing the 50-50 probabilities to play out over a larger sample set of coin tosses, right? So if we're thinking in probabilities, then let's go ahead and consider our equity curve to see how our profits stack up from that game. The win rate, as you recall, was 53%. So that means we had 195 total wins at $15, giving us $2,925 in gross winnings. And with 170 total losses at $10 each, we had $1,700 in gross losses. All right, so you net that out, and we end up with $1,225 profit on the game. So the question becomes, was there any way to know the outcome before you begin playing the game? And we knew that we were going to profit $5 more than we would lose on each winning coin toss, right? We knew that from the get-go. So the simple math based on a 50-50 coin toss would have given us a profit of $925. Since the outcome was a little better than that in our favor, we actually ended up with the $1,225 as our actual profit. So if the win-loss ratio would have gone, say, the opposite way with 53 losses and 47 wins as a worst-case scenario, then our total profit would have been $600. But based on how the edge was created in the game, we essentially have three profitable scenarios with which to make a decision prior to actually putting any of our capital at risk. Okay, you guys tracking with me here? That makes sense? Okay, the probabilities were stacked in our favor from the beginning. Now, just because we have that edge doesn't mean that a trading strategy is going to deliver 100% winning results all the time. Remember, the edge has to play out over a large sample set of trades or coin tosses, as we're talking about in this example. So in looking at this example of an equity curve, we can see that we will have periods of drawdown, no matter how good the trader or no matter how good the strategy is. There's still going to be losing streaks, just like on the random number generator. We had losing streaks of 3 to 5 coin tosses, losing streaks of 10 coin tosses in a row, and that's where you get these pullbacks in your equity curve. So just like the coin toss example that we just looked at, you had to accept that the results of each coin toss were completely random, where you could either make money or lose money on each coin toss. So it's the same thing really in trading, right? We have to accept that the results of each trade are random, and we can either make money or lose money on each and every trade. So with the coin toss game, we discussed the fact that we had an edge from the beginning, right? The reward to risk was in our favor, and that gave us a higher probability scenario. So even if we lost more often than we won, the game still had a good probability of being profitable for us. Now in our trading, we're looking to do the exact same thing, right? We're going to look for an increase in our probability of success prior to entering a trade. So we'll be interested to increase both our reward to risk on each trade as well as our win-loss ratio with a large sample set of trades. In that way, we create a solid edge for ourselves in the market, and now we're all of a sudden trading with an edge, okay, not just strategy. Two key metrics are important for traders to watch for when assessing your performance over a large sample set of trades. So to gain an estimation of your profitability on a particular strategy, traders will typically track these metrics. Number one, the win-loss ratio. Okay, this represents the percentage of trades you can expect to win with a given trading strategy. So for example, say a 60% win-loss ratio would imply that on average 10 trades will consist of 6 winners and 4 losers. And understanding how often our trade strategies are profiting helps us to determine the appropriate reward to risk for that particular strategy. Okay, so the second metric then becomes the reward to risk ratio, or the expected rate of return for a specified unit of risk. So for example, a 1-to-1 reward to risk, again, simply means that we're willing to risk, say, a 1% to earn 1% or more on that trade. A 2-to-1 reward to risk means we're risking that same 1%, except we're looking to make at least 2% or more on that trade. Now, the higher the reward to risk ratio typically suggests that there will be a lower win-loss ratio, since price would need to travel further in order for the trade to be successful. Okay, so this is not necessarily a bad thing, since we can have a lower success rate on trades as long as it matches the reward to risk to make it a profitable outcome over a larger sample set of trades. Does that make sense to you? So to help us build this trader's mentality, let's go ahead and take a look at some key strategic thinking objectives to help guide our mindset and give us confidence in our edge that we've created for ourselves. Okay, so here we go. The two key factors, two key metrics for traders. This is our probability of profit multiplied by our average profit on the basis of our 1% account risk rule. So let's see how this works out for us. With a 60% win rate, we can expect a profit on 6 out of every 10 trades and lose on 4 out of 10. So that gives us a net gain of 2% on strategy A. The second trade strategy is a little bit different. This one profits at a rate of 40%. So our average profit is 2% and our average loss is 1%. So we're working then on a 2-to-1 reward to risk principle here. Okay, different than strategy A. We can say this another way. Okay, we're risking $100 to make $200 on each trade. And the only difference is we're losing more often than we're winning with strategy B. Okay, so let me ask you guys a question here. Tell me, which strategy do you like and why? And is money necessarily the only consideration? So on an average of 10 trades, strategy A profits 2%, whereas strategy B also profits 2%. So it's kind of a dead heat what would you guys do? Send me over your answer via the question box. Would you prefer to have strategy A or strategy B? All right, so just looking over your responses here, it's always really kind of a mixed bag when folks respond to this because there's really no right or wrong decision. I mean, some folks are saying, hey, I prefer strategy A, that's just me. I like strategy B. You know, I can hang in there through some of the win losses when I win. I want to win bigger. So it really just depends on your style. But a couple things to consider here would be just a number of things. How often do the trade strategies actually set up on your charts? Okay, does one strategy set up more frequently than the other? Okay, that's going to be a good deciding factor. Do you have to choose one or the other, or can you essentially have multiple strategies to work with? Can you use both strategy A and strategy B? And do you have the confidence to withstand the drawdown of a 40% win rate? Okay, you're going to be losing more often than you're winning. Some folks just mentally can't handle that as well. Other folks can. So just knowing yourself will help you to decipher, one strategy from the other in terms of which one you want to keep, which one you want to get away from. But you can also trade both of these together just as easily. So when we're attempting to develop a mindset approach to trading, we're looking to develop the ability to make difficult trading decisions, right? And we need the proper attitude and behaviors to best support those types of actions. So in doing so, we need to remain committed to reviewing our historical performance as a trader, okay, making sure we're still on track and executing according to our rules and our discipline. So it's very easy to get on a hot streak and then become overconfident and then abandon the discipline that actually got you there, right? Overconfidence, this might sound kind of weird to some of you, but it's the death of every trader. And that's the difficulty with trading, right? Is trying to remain disciplined in order to get confident in your trading and then getting to a point where you begin to make, obvious mistakes with undisciplined trading activity. Okay, so some other things you can do to improve. One key thing is to slow down when things are going good. After a good trade or a good day or even a good week, take a day off or, just trade smaller and actually take time to own the results of your labor. Okay, you'll find that you're now taking ownership of the profits that are actually in your trading account. They're not just numbers on a screen, right? If you need to transfer those profits out of your trading account and begin working at a baseline amount once again, this tends to reset your expectations and just helps you to rein in that confidence. Gear up your mind to understand and respect the markets, knowing that anything can happen at any point in time. So we need to be able to protect ourselves and protect our trading capital while we're engaged in the markets. Here's an example of a winning mindset and a losing mindset. Let's take a look at Trader A and Trader B. Trader A has a positive expectation that every trade is going to be profitable. He's willing to accept full responsibility for his actions in the market, and he makes it a point of learning from his mistakes. Okay, and on the other hand, Trader B thinks that the market's out to get him. Okay, he blames his broker and the platform for his losing trades, and for some reason he can't admit to his mistakes and consequently learn from them. So who do you prefer to place your money with, right? Yeah, it's obvious choice. It's Trader A, right? He's got his act together. He's structured in his thinking. He has a positive outlook about what he's doing, and most importantly, he's trading responsibly. And so let me just ask this question to the group. I mean, is there anyone on this session tonight who fits the description of Trader B, or maybe just maybe one or two of those habits that we described for Trader B? And don't worry, I'm not going to call out your name or anything like that. Just want to see if there's anybody here that can take the first leap of faith and just say, hey, you know what? I'm a Trader B, or I used to be a Trader B, or try and get away from a Trader B. Is there anybody like that out there? Just shoot me your answer over the question box. All right, so we got one guy who's saying he's a Trader A. That's it. No trader bees out there? We need to get you guys teaching this course. I'm here. Okay, so we got one. We got one guy. We got two now. Okay, so we have two people who are admitting to being a trader bee. And I'll tell you, the reason I asked that question, and we're not just joking around here. It's really, people that are coming on these courses are looking to they're looking to straighten out some problems that they're having trading. They're losing money, or they're making money and then giving it back, and they're struggling at break even. And so the reason we're asking these questions is to, one, get people to own up to what's really going on. You can't solve a problem until you really start to own it and really saying, hey, you know what? I'm not a good trader and I need some help. And that's kind of the first thing, is just admitting, hey, you know what? I may not be all of this, trader B guy right here, but I may own one or two of those things that are really hindering me from making consistent profits in the market. And so that's all we're trying to say here. We're not trying to embarrass anybody or beat anybody up, but the best thing you can do is just admit when you're doing something wrong, because if you don't know you're doing something wrong, chances of you fixing it are pretty unlikely. All right, so many top athletes use a process called visualization. Okay, and what this does is it keeps them focused on the task at hand. So how can visualization potentially help your trading? All right, for starters, you can begin to visualize the perfect trade setup in your mind, and all of the those technical factors that comprise that trade strategy setup. Finding an optimal chart structure, finding a strong trend to trade, looking for predictable price action in the market, making good risk assessment, all of that, just thinking that way as you approach the markets is going to give you confidence in what you're looking to accomplish. Okay, you can visualize a successful trading outcome by doing that, realizing that losing trades are just part of the business, but overall you expect a positive outcome from this activity of trading, right? You can also visualize yourself executing that trade setup flawlessly and then utilizing all of your trading plan disciplines to accomplish the task. Okay, another aspect of visualization is that it promotes a positive mental attitude about what you're doing. Okay, a general positive attitude can really help you to accept the trades that don't work out. Okay, losses are always difficult for everyone, but a positive mental approach to trading can definitely help in the recovery process. So just being positive about your trading helps you to accept the fact that you will make mistakes using the strategies. The markets are just a very interesting type of animal, just in the way that they move and kind of ebb and flow. The markets tend to present perfect opportunities to make mistakes. And that's why, we need to spot them quickly in order to prevent further damage to our trading account. So just remembering that our key responsibility is to protect our trading capital. Without that, we're no longer in business. Okay, so keeping a positive perspective also helps to reduce our stress level, provides us with some fun and enjoyment in this business that we love so much. So practice some visualization, see how that helps you. Make sure you're consistent with it. Pick out a time each day prior to trading where you can do some visualizations. You see athletes do it all the time on TV. If you just watched the Olympics a few months ago, you saw a lot of those snowboarders and whatnot. They're on top of the hill and they're just kind of going through. You can see their bodies even move as they're going through the gyrations of actually visualizing the stunt or whatever it is that they're about to do. And athletes do this because it works. And so it's really the same thing in a lot of other things we do outside of sports and business. It works in trading as well. A few key things to keep in mind here. Gearing up for the strategy course can often be frustrating for folks, since there's a lot to learn, and you may end up making some mistakes, right? The material is not difficult to understand, but it will take a lot of practice in order to implement it properly in real time with real money. So the key point I want to stress here is, don't plan to make a lot of money or lose a lot of money while you're learning these strategies. Okay, learning is learning, and trading takes time to learn. But the lessons learned here can cost you. So don't let that be the case for you. Start out trading small, managing your risk. You'll need to see a lot of different looks that the market will give you while you're building your base of experience. Okay, and also, don't be afraid to fail. I mean, here's a great quote by a guy I think you guys will all recognize, Michael Jordan. He said it this way. He said, "I failed over and over and over again in my life, and that is why I succeed." It's just that simple. At Traders Precision, we're of the belief that anyone can achieve better trading results if they just put their mind to it. What we're teaching is the process of getting good at doing something, and that always takes time, right? Henry Ford, he puts it this way. He said, if you think you can, you can, and if you think you can't, you're right. So, Henry Ford really initialized the Industrial Revolution in this country and idealized this process of specialized labor with the assembly line, right? So, pretty smart guy. In this section, let's get into this idea of price action mastery and how to become technicians of the markets that we're trading. So let me see here. We're almost right on 10 minutes before the hour. We're starting up a new section here. Why don't we do this? I've got to refresh my water glass here, take a little bit of a break for my voice. Why don't we take just a 10-minute break? We'll reconvene just a couple of minutes before the top of the hour, and I'll get a little timer up on the screen here for you, and we'll take a break and do it that way. Okay, so let me put everything on hold, put everything on silent. If you guys have some questions, you can use the opportunity, the few minutes, just to shoot me over some questions. And before we key up this section here in a few minutes, we'll address some of those questions and then move on to our next topic of price action mastery, which I think will be an eye-opener for you guys. If we have any questions here, we've got no questions, so it looks like we're good to go, ready to jump back into this section here. We'll get rid of the timer, and we'll jump into this section on price action mastery. You guys ready to go? All right, so price action mastery is about making sense of what otherwise seems to be random price movement in the markets. And what this does for us as technical traders is it introduces some logic into the trading equation for us. Okay, so the idea is, if just one technical factor pertaining to a price chart can put the odds just slightly in your favor, then what would happen if we introduced multiple technical factors into the trading decision and then use that as our basis for trading with logic and reason? Okay, at Trade with Precision, as part of the strategies that we trade for our own account, what we do is put together as many leading technical factors as we can in order to build a higher probability trading idea. So that's the baseline of what we're doing here when we trade our own account for a living. It makes sense then that we're trading based on logic and probability and understanding what price is actually telling us. So what we're not doing is trading based on a hunch or based on a news release or what the guys on CNBC are saying or what major fund managers are doing. This is not about guesswork or some kind of an instinct of any kind. We've actually boiled it down to something that's repeatable, and it's based on logic and reason and what we can actually see and determine by looking at a price chart. So when I talk about multiple ingredients or multiple technical factors, this doesn't mean that it has to be difficult to understand or implement. A good analogy would be if you can think back to let's say when you first learned to drive a car. You felt like you had to do maybe 15 things all at once, and then trying to find the radio station you wanted at the same time, it almost seemed impossible, right? But once you practice for a while with your learner's permit and someone kind of mentored you on the finer points of driving, then you mastered it. And now all of those 15 different things are being done just out of habit now, or they're just done automatically, right? So it's kind of the same thing with our trading. So here's an example of what I'm talking about. Which chart setup would you prefer to trade? Okay, the one on the left or the one on the right? The chart on the right looks a lot simpler and cleaner. We can actually see the price action a lot clearer along with those moving averages that we're looking for. The chart on the left looks almost identical, except there are a few more indicators on it, which makes it a little bit difficult to read. Okay, it looks like maybe there are Bollinger Bands and maybe some Keltner channels on that chart, as well as the addition of the moving averages. So the point here is that the more indicators that we have on the chart doesn't necessarily help us more. Sometimes it actually hurts us because all this stuff just gets in the way of what's actually important to us. And at Trade with Precision, we follow what we call the KISS principle. Okay, simply meaning to keep it simple, stupid. And that might sound funny to some of you, but it's the truth. And many times, the simpler the trading strategy or the simpler the setup, the better off you're going to be. I mean, just as people, we only have the ability to calculate so many different variables and think about a few different concepts simultaneously. Otherwise, we get into what's called, analysis paralysis. So we're trying to figure out too many variables at the same time, and then we can never actually arrive at a trading decision. So the market has already made its move, and more than likely you've missed out on the trade possibility. So keep it simple as you learn these trade strategies. A lot of folks feel compelled to add additional indicators and things to the strategies, but again, just use them as they're defined here in this series, and you'll be good to go. All right. Okay, so what is mastery? And let's get ourselves a solid definition here of this term, since we'll be using it often throughout this series. A lot of times when we teach these sessions, folks just overlook the critical nature of this term, and it truly is the do or die scenario in trading. You'll need to master price action analysis along with the strategies in order to be successful. Okay, here's some definitions of the term mastery for you. It means to be in control or to be superior in one regard or another. And that definitely applies to trading. Okay, we always want to be in control when we're putting our capital at risk in the markets. Emotional control, risk control, profit control, control over when we enter the markets, control over when to remain out of the markets, okay, is just as important. Comprehensive knowledge on a particular subject matter. That's why we're going through this course, right? We want to have complete understanding of the fundamentals of price action and trading strategy, and we'll only get that through many hours of practice and repetition. Okay, looking at our charts, finding those trade setups time and time again. So having skill in a particular activity, that's mastery. That's what we're talking about. So being a skilled trader, what does that mean? Well, that means you have a skill set that can generate consistent results. It's like an athlete or even a business person, whether you play baseball or you sell computers, you're skilled in that specific area, and a corporation is willing to pay you money for that skill. So a skill is not something that is just recognized by you, but more than likely it's recognized by those people around you. And in line with that thought, you have the power to win or to defeat, and everything in life is competitive, right? We compete for our jobs, we compete for our new accounts, new clients, we compete for a spouse. In earlier years of civilization, people competed with their environment for just basic survival. So having the power to win a higher percentage of the time is what's considered mastery. So begin by finding your own strengths and then leverage those areas. Okay, think back about what you've already mastered in your life, maybe a particular job or some skill set, a sport maybe, and there may be some crossover and other things that you're good at that may also apply to trading. Maybe you have an affinity for numbers, or you're just a very logical kind of person, or you already have the tendency to think in probabilities maybe, or you may understand a certain sector of business that may be applicable to your trading. So what steps will you take to ensure that you master the fundamental principles of trading and the trading strategies? You already know from other things that you've mastered in the past that it will take a time commitment for you to do that. Mastery will take practice, it will take dedication, it will take discipline. These are all the common concepts that just get us closer toward mastering something that we want to do. Now at Trade with Precision, we believe that trading success comes to those who make it a point of mastering price action in the markets. And by mastering price, you now have a critical element in understanding the next potential move in the market. Okay, if you've ever heard the term price is king, that's what we're talking about here. Whether it's an economic report or a news announcement or an earnings release, all fundamental information ends up being reflected in the price of that asset. So if we are a student of price, then we can see what's happening fundamentally. Okay, we know what other investors are doing. We know what the major funds are doing because that activity is going to be priced into the market, and we can see it reflected on a price chart. A guy by the name of Bruce Lee once said this about mastery. He said, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So that's coming from the martial arts master. And if price action then is so important, then what is it? Okay, well, price action is simply the price data of an asset plotted onto a chart without any indicators or anything else. Okay, just raw price information. And when you become trained in reading price information, such as on this chart, you'll be much better adept at forecasting the next near-term move in price. So we know that price is the purest form of data that we can trade off of. All other indicators are just a secondary measurement of the price action itself, and that's why according to many successful traders, price is king. Okay, so just by looking at this chart of price alone with no indicators or anything on it, you can begin to see the trend that price is making here, right? You can see that price continues to make lower highs and lower lows in this downtrend. There are pullbacks or rallies to various resistance levels, and then price continues down in the direction of the predominant trend. Candle sizes are all very uniform throughout this trend, which tells us that price is very predictable and there is consistent selling pressure in the market here. Okay, so we also notice that there are consistent pullbacks into the trend line, and again, those rallies are met with selling pressure once again. And we also know that trends usually end on large candles across multiple time frames. So all this information about price on this chart tells us that the trend is very likely to continue lower. And we don't have anything else on this chart other than just price. Okay? So when we master price action and have a very detailed understanding of price, you'll find that the indicators are no longer necessary. Okay, they really become just the icing on the cake for us, since we're building our trade idea on the underlying price itself. Now, this is usually kind of an aha moment for a lot of folks who have been taught to trade various indicator buy-sell signals, only to realize that these signals are lagging the price action by a significant margin. So there's a definite benefit to mastering price action, like we're talking about here. And we talked about, what it meant to master something in life, right? So mastery then is about knowing something at a much deeper level so that it becomes second nature to us, just like, driving a car. And these are then the elements right here that you'll be responsible for mastering during the course of this series. So let's go ahead and just review them quickly here. Optimal chart structure, going to be one of the very first things that we look at in any chart that we want to trade. We simply want to find a price action structure that's reliable, it's predictable, before looking for our trade setup. Trading with the trend, something that all of you have probably heard a lot about, or maybe said another way, the trend is your friend. But do you know why? That's the big question. Going with the market momentum, it's just going to be one of the safest ways to trade the markets and protect your capital from losses. There are many counter trend strategies as well out there, but they just tend to be lower probability setups. So price action support and resistance is another key fundamental in trading. So being able to identify these critical levels makes all the difference in our strategy setups and where we take our trade entries. Okay, not all support or resistance levels are created equal, so it's critical to be able to determine these key levels correctly so that we know how to trade around them. The moving averages are commonly used incorrectly by a lot of traders, trading various line crosses, which end up being lagging indicator signals compared to price. Moving averages can be used as a leading indicator of price movement and direction if we understand the patterns and the zones created by the moving averages. Okay, moving averages can also provide us sensible areas and when to buy and when to sell. Candlesticks, these will be another important part of our strategies, and knowing what to look for in the candles can once again make all the difference in understanding where to place your stop or how to define your entry. Multiple time frames is going to bring it all together for us as we look across a wide spectrum of time frames to find the most reliable trends. So finding our trade setups across multiple time frames, this will increase the probability of our trade outcome. Now, these 6 items are going to be really the key to price action fundamentals that you'll need to master in order to trade effectively with these strategies. Okay, so it shouldn't be too difficult. It'll just take some time for you to learn. So let's go ahead and get started here by taking a look at optimal chart structures in order to get familiar with what you'll need to understand about trending price action. How do you identify an optimal chart structure? We talked about optimal chart structure since it's critically important to the strategies that you'll be learning here in this series. An optimal chart for trading should be obvious to you at the first glance. Okay, this isn't something that you really have to labor a lot, over a long period of time. You open the chart, and if it doesn't hit you right away, like, wow, that's a nice trend, just move on to the next chart. Okay, as we look through various chart examples in this series, you'll notice what I'm talking about when you see smooth flowing charts and candles that are clean and trending, and they just look predictable. So as we've talked about before, trading is about getting the probabilities stacked just slightly in our favor, right? And by trading only optimal chart structures that are trending nicely, right, you increase the reliability and the predictability of where price is likely to go next. And so this is the goal of what we're trying to accomplish here. We don't want any kind of guesswork when we're trading, because the market will continue to test our resolve when we're finally in a trade. So you really have to have full confidence in what you're doing. Be very clear that you're willing to lose a small percentage of your trading capital on this high probability trade. And that's the kind of thinking that is really going to keep you in the trade until you either hit your profit targets or you're stopped out. That's the idea. We know then that the charts that we want to trade, how about the charts that we don't want to trade? What do they look like? So you'll want to avoid charts that have no clear and no obvious trend in the price action. If you see a lot of gaps in the price, that typically means that there's low volume, and that's not going to be a good chart structure to trade. It's easy to get stopped out on gappy type charts. Also, along with gaps, you'll see spikes in the price action, creating candles with long shadows or long tails. Don't want to be involved in this either. Okay, usually all of these things will be accompanied by just erratic price action, no clear succession of higher highs and higher lows, or vice versa for a downtrend. And usually these charts are where amateurs are trading. Okay, they're not using a stop loss or a strategy, and they're just trying to trade the range. So when you see charts like this, just make a plan to move on to the next one, save yourself the time, and save yourself the trading capital. Now, trend analysis. This is by far the most important technical analysis tool I think you'll ever learn. Not only are the two strategies you're learning based on it, but if you can't identify a strong trend and then predict a continuance, you'll constantly be second-guessing yourself on when to actually join a trend. And if you don't understand the fundamental building blocks of trends, then indicator divergence, it's never going to make any sense to you, and you won't be able to identify when a trend is actually weakening. Also, things like Fibonacci retracements, these won't make any sense to you either, since they apply to strong trends as well. So just to state it simply, strong trends are going to be some of the easiest opportunities to make money in the markets, but if you don't understand them inside and out, you still run the risk of losing money. Okay, so it's the analysis of peaks and troughs, the highs and the lows, is what's going to give us the indication of who's in control of the market, the bulls or the bears. Find it very common whenever I present these trading strategies to new folks. For some reason, they just always want to shortcut the strategy and enter the trade before getting full confirmation of the precise entry. Okay, the reason we're trading strong trending charts is because we get the predictable price action behavior that we want to see, which provides us with very specific setups for our entries, our stops, and our profit targets. So we're in the business of finding these trends and then just riding them until they end. That's the idea. Now, a lot of folks talk about trends, but they have the tendency to be the least understood, I think. Trends can be very simple in nature, and they can also be very complex as well. So it becomes difficult for amateurs, just learning to read trends and technical analysis, to manage more complex trends when everything isn't completely obvious to them. Okay, so don't overlook the simplicity. You want to stay focused on the trend fundamentals, and it will come in handy when the actual complexity arises. So going with the trend is going to be the highest probability form of trading. It simply means that we're going with the path of least resistance, and we're following the market momentum. Counter trend trades are going to be the lowest probability outcome, and usually that will be when amateurs are trying to pick tops and bottoms in the market. So just remember that a wealth of information about a trend is going to be obtained from the price action alone. So spend a lot of time watching the charts to help you reinforce price action behavior and help you with your ability to read the charts accurately. Make sense? Taking a question here. Munir's got a question. What's the reason for spikes? No news, still many charts have spikes. Yeah, the reason for spikes is a couple of reasons. One, it can be either an anticipated news announcement, or it can be an unanticipated news announcement, which means you'll get a spike in price action in either direction. So it's going to be basically a fundamental move instead of a technical move in the charts. Another way to get spikes is simply with low volume. Okay, so whenever orders come into the system, the price action is basically just spiking around, and the computer is looking to fill those orders that are coming into the market. So with intraday trading, that type of spiky price action, low volume is not what you want. When you're swing trading, you can just move up to a higher time frame that doesn't have all those spikes. It still may be a lower volume chart, but you're just not going to have all the messiness of the lower time frame. And then plus with a swing trade, you're looking for a longer term position. You're going to have wider stops, wider targets, which some of that price action slop doesn't affect you as much. But for the most part, we want to look for clean charts, good trending chart structures, and good volatility and good volume. Okay. Here are some common mistakes of amateurs in their thinking. Okay, they're looking at a chart like this, and somewhere on the way down, they start to think, hey, this market can't possibly go any lower. It's so cheap at this level. And guess what? The market can always go lower or higher than you think it can, and often it does, right? So even the analysts get it wrong often. These guys are tracking a lot of markets, a lot of stocks, and the information on recommendations is just not always up to date. Many professionals in the industry are trading other people's money in one fund or another, and the fund managers are committed to trading according to the prospectus for that particular fund. So if it happens to be a long-only fund in a down market, then they're committed to a position that's just not going to be very effective in a down market. But that's what they're getting paid to do, right? So when you hear people talking on the financial news networks, you have to remember what their bias is and understand what fund they're actually managing. So for discretionary traders like us, we have the ability to change direction when the price action tells us to do so, and it's much easier for us to get in and out of the markets quickly when the technicals change. But as trend following traders, we need to be using our strategies and price action analysis to find high probability trading ideas going with the predominant trend in the market. All right, you with me? Let's take a look here. Another question. Spikes are touching my stop loss, 10 to 15 pip stop loss. Yeah, if you're just if you don't know where to place your stop loss, we'll teach you that in this 4-part session. A lot of folks, a lot of amateurs use stops, but they're not placing them in the appropriate places. So the idea behind placing a stop is to place it behind a significant level of support or resistance, so that your stop loss is protected, well protected. And so the likelihood then of your target being hit is very likely, and the likelihood of your stop loss being hit is very unlikely. Because if you're going in the direction of the predominant trend, putting your stop loss below a significant price support or resistance level, then now you have a couple of things working to your advantage. Okay, so if you are trading gappy charts or low volume charts, then you do run the risk of getting a spike, getting your stop loss hit on a spike and getting stopped out for a loss. That can happen as well. HB is asking, there's a lot of talk of a crash. Do the ingredients alert us to it? Yeah, you can. You're always going to have that in a strong uptrending market. I mean, even if you look at the stock indices that have been uptrending now for 5 years, along with some other major forex pairs as well. You're going to find that there are always people that are going to come out, try to rattle the markets, and do some different things, but you really just have to stick with the trend and do what the technicals are telling you to do, and you're just going to have to learn to trust that over time, and that's something that can be difficult for folks to do. So Munir is saying, I can't trade with a 10 pip stop. No, Munir, you can trade with a 10 or 20 pip stop. You just want to understand why you're taking a 10 pip stop. If you're trading on a 1 and a 2 minute chart and you have a 10 pip stop below a key level of support or resistance, or below a key candle, then that's the proper way to do it. In other words, you're allowing the price action to tell you where to place your stop loss. It's not just, you're not just placing it 10 or 15 pips away from your entry just because you feel like it. You know what I'm saying? So we'll show you how to do that in the next couple of sessions. We'll talk a lot about identifying your risk and placing your stop, because that's really important to the strategies. Okay, and it's also knowing where to place your stop is incredibly important to predicting your profit target, and we'll show you how to do that based on identifying your risk level. Okay. All right, so the common mistakes made with trends is, first of all, not understanding the fundamentals of how a trend builds upon itself with the price action. Okay, trends are usually taught first on most trading courses and books, and the basic definition of higher highs and higher lows, or lower highs and lower lows, is somehow lost in the translation. Okay, so the most simple aspect of a trend has a tendency to elude people, and this is really just a big mistake. So as technical traders, the trend is going to be the most important thing to us, and without it, we would really have no entry, no stop loss, and no profit target. Okay, Fibonacci retracements, they only make sense when the price action is in a strong trend. Indicator divergence only makes sense when the markets are in a strong trend. Okay, even counter trend traders need to recognize when there's a strong trend in order to find a weak point or a potential reversal point to actually trade against that trend. Okay, so I think you get what I'm saying here. Going against the trend, it sort of feels like you're swimming upstream. Okay, it's not a great feeling. Stick with the trend and stay with the path of least resistance. It's definitely the higher probability trade. So let's just review here real quick the price action of a trend, successive higher highs and higher lows. And typically in a solid trend, you'll see the price action taking 2 steps forward and 1 step back. And we call these 50% retracements. And they're the typical building blocks of every strong trend that we see. So our job as traders is to look for buying opportunities in the uptrend until the trend shows signs of changing. And that change then is going to be evident in the price action that we're looking at. And so the rule of thumb of the trend is when you think it can't go any higher, that's exactly what it does, right? And so we're not trying to call tops and dot bottoms in the market here. We're just identifying and following the momentum in the price action. We're not looking for reversals with these trade strategies. We want to follow a well-established trend. Okay, so usually the first and second pullbacks in these trends are the best opportunities, but that doesn't mean that you can't participate in other pullbacks. You just have to pay attention to the time frames you're following to better estimate the duration of the trend, and I'll show you how to do that as we get further into these sessions. Now, in this next example, we now have a downtrend, and I find that folks always tend to gloss over this part because it just seems too easy for them. It's like, okay, Toby, higher highs, higher lows, lower highs. Like, okay, I get it. Let's move on to the advanced stuff. And quite frankly, this is the advanced stuff. Okay, but what folks I think don't realize is that every chart pattern that they'll ever learn is going to be hidden in these lower highs and lower lows, or higher highs and higher lows. So for example, on this downtrending chart, the very first thing that we'll notice is that price will stop making lower lows at some point, and we'll eventually get a higher low. Then we'll get a higher high. So we don't need to remember the names of the patterns. We just need to understand what's happening in the price action itself. Okay, so price action doesn't lag. It tells us immediately what's happening in the market that we're looking at. We'll see short-term changes in trend, otherwise called a bull flag or a bear flag. But again, it's just a change of trend. We'll see consolidations that will then continue on in the direction of the trend. This is just a breakout or a continuation. So once you begin to pay attention to the price action, it will tell you a lot about what is most likely to happen. And you don't have to remember all the different patterns. They don't matter because you're actually reading the underlying price action. Make sense? Okay, here are some trending charts for you to look at. You can quickly identify as soon as the chart comes up that it's an optimal chart structure, right? And the thing that tells you that is the price action, higher highs and higher lows. We can also see the price action pullbacks to levels of previous support and then reversing and hitting higher. Scanning for trends like this just makes it really easy when you know what you're looking for. So at this point, we found a solid trend, and we're just stocking it now, and we're waiting for an entry opportunity. Okay, so the downtrend here is going to be just the opposite. Lower highs and lower lows form the trend shape right here. You can see rallies in this downtrend that move right back up to a previous support level that's now being retested, and it's turning into resistance for the next move lower. Okay, so these are the classic building blocks of every strong trend. Make sure you memorize them and understand them inside and out. And I think this knowledge will continue to pay dividends for you for years to come. Now, the thing you don't want to do here is try and trade these short pullbacks, okay, such as these moves right here and these moves right here going against the trend. Okay, you'll never be able to call them right, and you'll always miss it. You see countless folks weekly that they're trying to trade these charts in both directions, thinking that that's the right thing to do. Just make it a point of understanding that when you're trading a trend, you're working that trend from a single direction only. Okay, and what that does is it just helps you to stay in the right frame of mind, helps you to keep a positive and consistent expectation about your trade setups. So we saw an uptrend, a downtrend, and then there was no trend. Okay, so a no trend chart scenario is obvious because you have no clear succession of higher highs or lower lows. So everything appears mixed and directionless, including even the moving averages if we were to have them on this chart. So as you can see in this example, you get a lower low, then you get an immediate higher high, and then sometimes you'll get a higher low, then followed by a lower high. Okay, so most folks will call this a ranging market, and depending upon the chart time frame that you're looking at, this could last a few minutes to a few hours, even a few days. And sometimes this is where you'll get a change in the trend or some type of a bottoming structure even. So by understanding price action and trends, we know when to get cautious on the markets and to move to the sidelines and wait for some clear direction from the price action that we're seeing. Okay, so that signal will typically be some kind of a breakout from this range, either higher or lower, and then you would start to see the price action beginning to trend again, and then you're back in business. Okay, so there's no need to guess here on which way the market is going. You can just wait, and the price action will tell you. During a trend change, as you can imagine, and as many have often experienced, fantastic opportunities do exist at the beginning of a new trend. And this is where the reward is by far the greatest. But the problem here is that it's really kind of a blind guess as to whether the markets are going to reverse or not at that particular point. So you get many novice traders who are looking to pick a bottom or a top in the market, and that's why many call this catching a falling knife or stepping in front of a raging bull. And so if you've ever tried it, it's not very fun experience, and it's definitely not worth trading. And you'll just find that if you give the markets time, there will be a bottoming structure revealed, and that's when traders begin to trade the market turns. And this is typically going to be much later than when the amateurs are jumping in to call that top or bottom. Okay, there's no money in tops or bottoms. It's just a complete waste of time and capital. If you want to get in on a trend reversal, then there is a proper way to do that. First of all, you just have to be patient because trend changes take time, and that's because traders are continuing to trade the current trend until it shows signs of ending. Okay, so once a change in trend is confirmed, then you'll see the market reversal begin to take shape, and you'll be able to identify a clear trade setup going in the direction of the new trend. Munir is asking, what do you mean by confirmation? We're actually going to show you in some of the upcoming sessions, Munir, what that confirmation looks like. And what we're looking for are basically those higher highs and higher lows again, or lower highs and lower lows. So it's going to be a change in the current direction, and we'll show you exactly where those changes occur, and we'll probably do that as early as next week in part 2. Chan is asking, would like to know which time frame will be better to use on the trend. Yeah, it doesn't. Get that question a lot, Chan. It doesn't matter. These strategies will work on any time frame, any asset class. Okay, so what we're showing you here are chart structures that occur on anything from a 1 and a 2 minute chart all the way up to a weekly and a monthly chart. So it really has no dependency on what time frame. When you're scanning through your charts, you're looking for the time frame where the trade sets up on. So basically you're scanning all the time frames. Does that make sense? Okay, so let's talk a bit about changing trends. So trend changes can be simple or they can be complex. Trend changes at their simplest are really just a product of a higher high and a higher low, or a lower high and a lower low. Okay, unfortunately, it's just not always that simple in real time, as there can be multiple trend changes in a single trend. Okay, but the formal confirmation of a trend change is a higher high in a downtrend and a lower low in an uptrend. This doesn't mean that you automatically begin trading that trend, since this is very typical of a pullback within a trend. Okay, so here's kind of how it works. If the market is in a downtrend like we see here, then the first signal of a trend change is the first higher low right here. Okay, the confirmation of that trend change then occurs at the first higher high, which is right here. So if the market is in an uptrend, such as it is here, then the first signal of a trend change, again, is going to be the first lower high right here. And then the confirmation of that trend change occurs at the first lower low, which is right here. Okay, so the first key to a trend change is the first higher low in a downtrend or the first lower high in an uptrend. But I'll give you some more tools in this session to help you predict when major trend reversals are about to occur. Jason's asking, when can we sign up for part 2 of these series? You can. I'll take you at the end of the website. You can just go to the Learn tab, and under the Forward Thinking Traders session, sign up for part 2. You will need to have an open account with Oanda to do that. And as long as you have that, you'll be all set and ready to go. But I'll show you at the end of the session how you can get set up. So here's a second trend change pattern that's fairly well known, the head and shoulders reversal pattern. And again, the idea here with reversal patterns is to focus on mastering trends. And in that way, you'll essentially have already mastered market reversals without actually getting bogged down and knowing all the different names of all the chip and chart patterns. So let's go ahead and explore the head and shoulders pattern in a little more detail right here. Here we have a downtrending market, downtrending chart. We have lower highs, lower lows. And then different from the double bottom pattern that we just looked at, where we went from a lower low to a higher low directly. Okay, in this case, we go directly from a lower low to a higher high. Okay, such as you see right here. Okay, this signals us to the left shoulder and head development of the pattern, and then we put in the higher low right here. So only until this higher low is in place do we have the head and the right shoulder confirmed, and then the head and shoulders pattern is in place, as you can see. The head and then the two shoulders, and then we're getting a break of the neckline. Okay, so the first heads up signal to this trend change is the exact opposite of the double bottom, right? It's a higher high instead of a higher low. So once the higher low is in place, we can then see the complete formation of the head and shoulders pattern. So the key concept here is to watch the trend and identify these first signals that will give you advance notice of a potential change in the current trend. The second example here is just the opposite, beginning with the uptrend reversal. And you can see the pattern forming the same way, coming down into lower high and then a lower low, confirming the pattern once again. Okay, you with me? Munir's got a question. What is pips and targets for beginners? Actually, Munir, all of the pips for your risk, as well as the how many pips for your profit targets, are all calculated based on your entry and your stop loss. So in the next session in part 2, we'll show you exactly where you're getting in on these trades and identifying your entry. And then that means you're going to be identifying your risk, which is your stop. And then based on those two pieces of information, you'll be able to identify your first initial profit target so that you can get the trade to break even as quickly as possible. Okay, so we'll be showing you that probably next week. Now, when we're looking for good trends to join, we're not waiting around for some long, lasting trend. We can jump in on, the first or second pullback as the trend gets started. But as you can see on these charts, the reversal pattern is in place, and now we're looking to take advantage of the new trend direction, right? So this may look, confusing to some of you, but you have to consider that we're not looking across multiple time frames here either, right? We're just looking at one chart. So there are both continuations of a higher time frame, existing trend that just happened to incorporate a reversal pattern into the trend change on the lower time frame. So if you've never worked across multiple time frames before, then this will be new to you and may take some time to help you understand how the reversals happen within that framework. But we'll be talking a lot about this as we continue on with these sessions, helping you to understand trends within a trend and then how to identify these so that they become tradable opportunities for you. But in this case, with these two charts here, we're just showing you a single time frame to illustrate the reversal pattern and the point of entry into the new trend direction. Okay. So here's a good chart to see a series of trend turning points with a continuous downtrend on a lower time frame. If you were to move up to the higher time frame chart, you would see this as a smooth flowing downtrend. But as you come down to the lower time frames, you begin to see more dramatic retracements simply because of the time frame representation. So that being said, this chart illustrates for us the reversal patterns that we were just looking at. The first one in the top left, right here, it's a nice head and shoulders pattern with a lower high and then directly to a lower low and then breaking down through the neckline, giving us a full picture of when to trade and where to enter the trade with our strategies. Next, the set of dotted lines, red lines, represents to us a higher high followed by a higher low, and then we can anticipate the next higher high to look for a trade entry on this first pullback. The third turning point is off of this move to a lower low followed by a lower high and then breaking down to form this trend change that we see right here. And then the last trend change here is in the bottom right, where we have a higher low moving up to a higher high, and then we can anticipate the higher low again as our entry signal. So it's critical to understand, how these turning points happen and knowing where to apply the trade strategy entry within the price action that we're looking at. So these are obviously just trades very close to the trend change. There are plenty of other opportunities to trade well-established trends also. But as you get better with your price action analysis, you'll be able to spot more trades setting up in slightly different situations with potentially a combination of trade strategies setting up all in a single trade, but maybe just across multiple time frames. So if you don't understand the stuff that I just said, don't worry about it. We'll be talking a lot about this in the coming sessions, and we'll have numerous examples of all this stuff as well in the following sessions. So we've looked at optimal chart structures that we want to trade. So let's go ahead and take a look at some charts that we want to avoid. Now here we have a low volume gappy type chart. You can tell this by immediately looking at the chart and just noticing the odd looking candles and the formations created by the price action. Okay, these charts are more common, I think, in stocks where the market closes each day, but that doesn't necessarily mean it's a gappy chart. Okay, it's typically just a difference between the market close and the market open. And if the charts are gappy during regular market hours, then there's a reasonable doubt about the volume and liquidity for that market. Okay, futures markets can have gappy charts as well, since there are times outside of regular market hours around the globe that tend to cause this. But as soon as the new region opens up for business hours, whether it be the US or Asia or Europe, volume then surges. Okay, so it's, again, just a matter of understanding the market open for various regions around the globe. Foreign currency, similar to the futures markets, where you may see gappy charts on various Forex pairs before global markets open around the world. It's really just a matter of people waking up around the world, getting their business day started. So you just want to be aware of this and avoid looking for trade setups during some of these off hours. Another chart pattern here to avoid as a spiky looking chart. This should be very obvious to you. You'll typically see very large candles with large tails, very little follow through in either direction. Again, you'll recognize this chart as soon as you look at it, right? Even though there may be somewhat of a trend here, with lower highs, lower lows, you run the risk of getting stopped out on a large spike in price. And you can also tell if you're executing your strategy flawlessly, you don't have very good setup candles to work with here either. So the strategy is not being employed on an optimal chart structure, which is our first requirement of the trade strategies. So again, these charts are typical of less liquidity and mostly in those cross pairs that have wider spreads. So don't get whipsawed on these types of charts. I just move on and look for something else to trade that provides you a better setup. Another example of erratic price action on the chart. This one is a bit different, because we immediately see that we have no clear succession of lower highs and lower lows in this typical price action trend formation that we'd like to see. If this chart had the moving averages on it, more than likely they would be out of order and mixed up and not in the appropriate geometrical pattern that we'd like to see. So once again, the very first criteria of our strategy is to identify strong trending charts, and this is not one of them. Okay, there's no clear trend here. Big candles all over the chart, some price spikes as well. It's just not worth the trade. The price action is just not predictable in this instance. Munir's got a question: if spiky charts go into a lower time frame, then there is no spikes but small trend. Sometimes if you have a spiky chart, if you go to a different time frame, you'll see a different scenario. And on a smaller time frame, you'd probably see a trend in this particular instance. On a higher time frame, you wouldn't see any of this. You'd see that all consolidated into maybe one or two candles. So it's going to look different on the higher or the lower time frame, correct? Okay, so it's just like if this were, say, a monthly chart, then there would be some, and each candle would represent a month. I mean, this is almost a 2-year trend right here. You would obviously just go down a couple of time frames. The daily chart would be trending. The weekly chart would be trending. All the charts below that would be in a strong uptrend. And so that would be definitely a tradable trend. Even on this downtrend, it would be 1, 2, 3, a 4-month downtrend if this were a monthly chart. If it's a minute chart, then you go up to a higher time frame, and more than likely it's just a pullback into a buy zone or something. Okay? So when you understand how to read price action, you get a lot better at understanding what time frames are going to tell you something different. All right, so now compare those charts to an optimal bullish chart structure right here that fulfills all of our trending criteria. Okay, we have nice smooth trending price action here. We have pullbacks to support levels, pullbacks into the moving average zone, which we want to see, consistent bullish setup candles in the buy zone. All the moving averages are in alignment. They're all fanning out. They're all spaced out very nicely, moving higher in the direction of the predominant trend. Okay, so this type of chart tells us that there's good consistent buying pressure in the market. There's no erratic behavior here, no extremes of buying or selling. All we're seeing are just higher highs and higher lows, and those nice consistent pullbacks right back into the buy zone in and amongst that 10-20 period moving average. Another optimal chart structure to the bearish side here, nice downtrend. You can see the great setup candles in the sell zone right here. They're nice and small, which defines our risk and our entry, which is good. In fact, all the candles throughout this trend are pretty small and consistent, right? Nothing out of place, no out of place large candles anywhere on the chart. These are great predictable trends to trade since they usually end in a flurry with some big candles at the bottom with a lot of overextension from the moving averages, which gives us some very obvious profit-taking opportunities, right? So if we had the MACD and the RSI on this chart, that's going to help us to determine any divergence that would signal to us that the trend is weakening. So just by looking at the price alone, we can tell there's no bottoming structure that's forming here yet. We just have lower highs and lower lows. There's another bearish candle setting up in the sell zone right about here, and the low of that candle has just been broken. And so I'd be inclined to look at some higher time frames to determine any support levels that may be lurking nearby, giving me a good profit point to cover the shorts on this particular trade. Okay, so a little homework for you guys here on this one. A little bit of a class participation exercise. We have two charts here. Which one would you prefer to trade? And give me a little explanation why. What I'd like each of you to do is to just send over your answers via the question box on your screen, and to just kind of give me a one-liner, if you would, with your answer and your reasons for your choice. And I'll just be quiet for a moment and give you folks a chance to think about it, and then we'll go ahead and we'll review the charts together. Just want to make sure everybody's understanding what we're talking about and everybody's getting the concepts here. So send me over your answers when you arrive at them. All right, just looking at some of your responses here. Some folks are saying A, there's a nice smooth uptrend. Some folks are saying, chart A because it's making higher highs and higher lows. It's very clear. Okay, so most everybody's going with chart A. Some folks are saying chart A, there's a pullback into the moving average zone. Chances for a move up going with the trend are very probable. It's a great analysis. Very clear, higher highs and higher lows. Moving averages are in order, fanned out. Great. Okay, so, not very difficult. Let's just review these together here. I think you guys are getting it. So it's an obvious one, right? Chart A, nice uptrend here, higher highs, higher lows, moving averages all in alignment. They're spaced out. They're in order. They're fanning out in the direction of the predominant trend. Nice sized candles throughout this trend. Nice pullbacks into the buy zone throughout this trend. Good looking setup candle as well. They're nice and small. So the price action just it's very consistent and it just looks predictable. So I'd be waiting for the close of this setup candle right here and then look for the setup for the long trade going in the direction of the trend on chart A. Chart B here, really not feeling the love on this one. No consistent trend. There's no higher highs, higher lows. Very much of a ranging market that, quite frankly, I'm just not interested. I've got a lot better chart setups elsewhere, and I'm going to scrap this one, and I'm going to go over it, and I'm going to look for the trade setup on chart A. And that's what we're doing in terms of scanning the different markets that we want to trade, okay? So let's do another brief exercise on this chart. Let's mark the trend turning points. You guys remember when we did this with the two trend reversal patterns that we worked through. There are two trend changes in this chart. So just take a minute to find the exact location where the trend confirms the new direction. And just remember that you're using the price action to determine this. So it's not going to be a guess. We're actually interested in a very precise location. And since I don't have the actual prices on this chart, you'll have to look at some other different way to identify that trend change confirmation for yourself. So I'll just be quiet for a moment, let you guys think, and then we'll go through and we'll review these turning points together. Go ahead and send me over your responses and tell me where you found the trend turning points, and then we can look through those. All right, so I'm just looking at some of your responses here. And so I think some of you folks are maybe struggling with how to give me an indication of where you're looking at. And the answer I'm really looking for here is a higher high or a higher high or a lower low, something in that regard. And so let's just walk through this together, kind of show you what how I'm identifying this. The first trend turning point is right here with our first signal occurring at the higher low, and then the trend change confirmation occurring at the break of the higher high. Okay, and then the second turning point is right here, and our first clue is at the first lower high, and then the confirmation occurs at the break of the lower low. Okay, do these make sense to everybody? Okay, we're using the price action highs and lows to determine the directional change. And so we're actually getting a heads up when we actually get the lower high in place and we start moving down. We know not to be trading this market long because more than likely we're anticipating a new lower low. Same thing right here. Don't want to be getting short again because we've just broken up, and now we're in a higher high, higher low scenario, which we don't want to be shorting that scenario. Okay, you guys with me? So another class participation exercise. We have 3 charts. I just want you guys to all look at these trends, decide if each one is an uptrend, a downtrend, or no trend. Just take a minute here to look at these and then send over your response in sort of a one-liner via that question box on your screen. Something maybe like, A2 or, B3, something to that extent, maybe as kind of a shorthand. So I'll just be quiet for a moment, gives you guys a chance to think that over, and then we'll walk through the charts together. Okay, so I don't think there's a single person that missed any of these. Pretty simple. You guys can spot optimal chart structures now. Let's walk through these together real quick. Chart A, no clear trend here, right? No higher highs or lower lows to support either an uptrend or a downtrend, so it's basically a no trend. Chart B, definite uptrend. You can see the obvious price action, higher highs, higher lows. Nice pullback into the buy zone right here. Another setup for a trend flow trade going in the direction of the trend. Chart C, good downtrend here, lower highs, lower lows, a rally back up into that sell zone, getting set up for another potential short on this chart. Okay. All right, guys, good job. Here's what's coming up on Forward Thinking Traders. We've just completed part 1 of this 4-part series. We spent some time today talking about mindset and price action mastery, and that is truly going to be critical in order to be consistent as a trader. So here's a glimpse of what's on tap for parts 2, 3, and 4 of this Forward Thinking Traders series. Here in part 2 next week, we'll introduce you to the proper way of interpreting true support and true resistance levels in the price action. I think you'll find this to be very refreshingly different, and it will certainly impact your view of the markets and how you define key levels in your charts in order to begin to build your trade idea. Now, if you're currently using sloping trend lines to define your trend, a lot of folks do, you'll probably want to stop that after hearing this section. Sloping trend lines just have the tendency to be very subjective, and they don't typically provide very precise entry levels, and they don't also offer us good protection or protection for our stop loss. Candlestick patterns will show you how we identify our candles and what's important about them. You don't need to spend a lot of time remembering the 300 different candle patterns and all the corresponding names. We'll show you how to shortcut all that, how to limit the list to a basic structure of 3 types of candles to look for in your trading. We're looking for bullish, bearish, or indecisive candles. It's just that simple. Then we'll wrap up the basics of the moving averages and how combining the moving averages with price action can become a leading indicator of the next move in the market. So again, the fundamentals here will not be difficult to learn for anybody, but it will take some time to learn to put into practice for yourself. So make sure you get your charts ready for that. And then part 3 will be about understanding the bigger picture view of the markets. We'll be using things like convergence between price and the indicators to assess the strength or weakness of a trend and whether that trend has the likelihood to continue in the current direction. This will be another crucial item to master, since this signal will give us the confidence to continue trading the current trend until it actually ends. And then likewise, if we understand convergence, then we also need to understand divergence between price and the indicators. This leading indicator signal can effectively keep us out of trades and prevent us from getting into potentially losing trades. So divergence is a great leading indicator that tells us the current trend is weakening and it may be about ready to reverse. Improving the probability of a trade outcome by combining all of our technical ingredients together along with the bigger picture view by utilizing multiple time frames. We'll show you how to look for agreement among all the technical factors across several time frames as we can continue to build a trade idea technically. So this session will be critical to understanding all the basic technicals before we actually put it all together with the trade strategies in part 4. And then in part 4, we'll bring in the strategies. You'll learn the trend flow strategy, which is how to identify a strong trending chart with predictable price action, and then utilizing the strategy to buy or sell the pullbacks within that trend. So this is a very active strategy and will produce many trade setups within every strong trending market. And then there's the momentum breakout strategy, where you'll be looking for a strong trending market, okay, but the setup will be a break of the flat level going in the direction of the predominant trend, which in this case is to the upside. So we'll show you how to combine the technical factors to arrive at a high probability trading scenario when buying or selling breakouts. So these strategies will be then the recipe or the methodology of how to combine multiple technical ingredients to help determine a precise entry, a precise stop, and the profit targets for your trade setup. And by the end of this course, you'll have 2 trade strategies in your bag to trade a variety of markets across all time frames. So concluding our session for today, we'd like to thank you all for joining us and hope that you enjoyed the presentation, and would certainly welcome the opportunity to work with you in whatever capacity you may require. The Oanda team is available 24 hours a day, and to get in touch with us, here's some contact information for you, email and phone, or you can visit us at oanda.com for more information or to open an account. So once again, I'd like to thank you all for your attention. I hope you found the content useful. I will stay on a little while longer to field any questions you may have. If you are leaving us, thanks again for attending, and I certainly look forward to speaking to you again next time in part 2. But before you sign off, there is a short survey upon your exit. Please let us know your thoughts. We're always looking to improve on the content we're delivering to make sure that it's of value to you. So let me go ahead and take a look at the questions coming in. Actually, before I do that, let me take you guys to the website and show you how to get signed up for Part 2. You do need to have an open account with Oanda to get access to Part 2. Just go to oanda.com, click on Forex Trading, then slide over here, click on the Learn tab, and then come down to this little movie projector camera, click on Sign Up Now. It'll take you to this page. Just scroll down. This is the current schedule, and then where we're at right now is on the Forward Thinking group. You just click on that, and then scroll down. It'll take you to all 4 parts of the series, give you the breakdown, and then you click on the language on the right side here, and it'll give you all the different sessions on when these are going to be available. We're doing them all basically on Mondays, and basically on the same time frames. Okay, so that's how you get involved in Part 2, and that's going to be specifically on price action mastery, showing you how to read just raw price action and the underlying charts. And that's always the basis of everything that we're trying to do with these strategies. Let me take a look at the questions here, see if there's anything before we wrap up. Mike's got a question. Can we get a copy of the audio along with a copy of the slides? Whole lot of info here. You're right. No way I could write that fast. Yeah, no problem, Mike. What we're doing is you're going to get this shortly after the session in the form of a recording of all the audio and all the slides. So you'll have everything. You can just fast forward back and forth, cover the sections that you may have missed or need some more information on. We find that folks want to see these several times, and then once you actually start trading the strategies, folks like to come on the live sessions again because they just have different questions about some of the same information. So like learning anything else, repetition is really going to be key. So take advantage of the recordings. They'll show up in your email box. Just click on those, and you'll be able to see these as many times as you like. Thanks for all the compliments, guys. Appreciate it. Glad you enjoyed the session. Another question here from Benjamin. For intraday traders, what time frame should be used for a stop loss? Yeah, Benjamin, when you get your chart set up, we'll go through this in some of the advanced courses. Your chart setup, if you're intraday, is going to be basically a 60-minute chart all the way down to a 1 and a 2-minute chart. And so it just depends on when you're scanning through those time frames where you see the trade setup or the strategy setting up on. If you see it setting up on a 1 and a 2-minute chart and you're trading in the direction of, say, the 60-minute time frame, then a 1 and a 2-minute chart, more than likely you're only going to be in that trade for a few minutes. If you're taking a trade on, say, the 30-minute and the 60-minute time frame, you may be in the trade for a couple hours that day. Okay, so it just depends, but you utilize the time frame that the trade strategy sets up on to guide you and give you an inkling as to how long you may be in the trade. And then also, what you're going to find out is on a 1 and a 2-minute chart, well, we're going to show you in the next session where to place your stop loss for both the breakout trade setup as well as the trend flow trade. But you'll find that your stops are going to be below, the swing low or the swing high on those time frames, whether it's higher or lower. but also in terms of your intraday trading, you are going to have less risk because the candles on those lower time frames are going to be smaller. So your risk essentially is going to be smaller based on the price action. But remember, we're always placing our stops at levels that are technically supported on the chart, and we're going to be showing you how to do that throughout this session, okay? Anybody else with any questions that we can answer? We still have 3 sessions to go, so I can't answer them all today, but I think we're going to give you guys everything you need to know in terms of taking your trading to another level and trading with 2 well-defined trade strategies that I think will change your game completely. Okay. Anything else? I think Raheel from Hoanda has been responding to a number of account-related questions, so I think we've got all those covered. So it looks like the questions have dried up here, so we'll hold on then for next week for part 2. We'll wrap up the session for today. I'd like to thank you all guys for making it interactive. It always keeps it interesting, keeps everybody awake and paying attention, and I think you get your questions answered and all that. So have a great holiday and enjoy the rest of the weekend, and look forward to a great trading week. And make sure you look for some of this price action analysis in the upcoming week, so you're ready to go for part 2 session next week, Monday, and make sure you get signed up for that as well. So once again, guys, thanks, and look forward to speaking to you again next time. Take care.